Your natural gas trade can look smart at 9:14 a.m. By noon, it can still wreck you if it's too big to exit. Here's why it works. When your size is bigger than the tiny orders on screen, you don't control the trade anymore. Brian Hunter learned that. His fund Amaranth lost $6.6 billion in days. Next, you'll see the simple position sizing lesson hidden inside that blowup. Position sizing just means how much money you put into any single trade. A couch can slide into your apartment in 5 minutes. Getting it out? That can trap you for an hour. Sounds backwards, right? But you know why it happens. Going in, the hallway is empty. You can tilt it, shuffle, reset, and keep pushing. Coming out at noon, your friend is sweating. The stairwell is crowded. The couch jams sideways in the doorframe. You still own the couch. You just can't move it when you need to. A trade can trap you the same way. At 10:14 a.m., the screen looks calm. Enough people want to take the other side. Your entry feels easy. Then price jerks lower. Those buyers vanish. Your exit door gets narrow fast. That narrowing has a cost. Traders call it slippage, getting filled at a worse price than you expected. You hit the button expecting one price. Your order lands at another. If your trade is small, it hurts. If your trade is huge, it can turn a manageable loss into a disaster. What's interesting? That's the reframe Brian Hunter's story teaches. The danger wasn't just being wrong about natural gas. The danger was being so big that the market's doorway mattered more than his opinion. Entry feels like control because it's the part you choose. Exit is the part that tests whether you ever had control. So when you feel proud of a big size, flip the question. Not, how much can this make? Ask, if I need out in 60 seconds, who takes the other side? If the honest answer is not many people, your couch is already stuck in the door. That's why exit beats entry. A trade you can't leave cleanly isn't really yours to manage. It's managing you. If this reframe helps, subscribe, 2 of these a week. And that leads to the only question that matters before you enter. How do you check, in advance, whether the exit door is actually wide enough? Open the ladder at 9:42 a.m. 3 tiny orders sit at your price. Then 2 disappear. The chart still looks calm, but the exit door just got smaller. Before you make the trade bigger, ask 3 plain questions. First, if you had to get out right now, how many people are actually there to take the other side? Traders call that market depth, how many buyers and sellers stacked at each price. If the screen looks empty, your size is already too large for that moment. Second, how far apart are the 2 prices on your screen? One lets you enter, the other lets you leave. That gap is the spread, the gap between the bid price and the ask price. In busy markets, it can feel tiny. In thin markets, it can suddenly widen, like a doorway shrinking while you're carrying the couch. Third, if you hit exit, where would you really get filled? When your buy or sell order actually executes. Not where you hoped, where the market can actually take you. If the next available prices are several ticks away, that's slippage, getting filled at a worse price than you expected. Now turn those answers into size. Your position, a trade you currently hold, should be small enough that a normal exit still feels boring. If getting out requires luck, your exposure, how much of your account is at risk on a trade, is too high. So the real mistake is not being wrong on direction. It's needing a crowd that isn't there. And once you see that, the Brian Hunter story lands very differently. I know I'm right. That sentence blows up more accounts than I have no idea. You see it everywhere. You order a giant couch online. You measured the living room. It fits perfectly by the wall. Delivery day comes. The movers get it halfway through the door. Then they stop. The couch was right. Your belief was fine. Your control was the problem. Trading feels the same. On the left, you have huge conviction, how strongly you believe your trade reasoning is right. On the right, you have actual control. Those 2 things are not the same. Many beginners treat strong conviction like permission to go big. I studied this all week. The story makes sense. This has to bounce. So they take a huge position, a trade you currently hold. Then price moves against them. Volume dries up. The only exit is ugly. Now picture someone less certain, but more disciplined. Same idea, same chart, same market, but they keep the size small enough that they can still exit in normal conditions. That is position sizing, how much money you put into any single trade. Notice the difference. The first person is trying to be right. The second is trying to stay in control. At 2:17 p.m., your screen looks calm. The spread is only a few cents. Then sellers hit. The price drops. The gap widens. Orders disappear. That giant position feels like leaving a packed stadium through a side door. This is where funds get trapped. Not because the thesis, your specific reason for taking the trade, was crazy, because the size assumed a smooth exit in a market that could turn thin fast. And here's the thing. Big size doesn't just change your risk. It changes your behavior. When the position is too large, you stop thinking clearly. You delay the exit. You hope. You negotiate with the screen. you become a passenger in your own decision. So the real question isn't, how sure are you? The real question is, if this goes wrong, can you get out without drama? That sounds simple until you see what happened when one famous natural gas trader built a position so large the market itself became the trap. The speed of that collapse is the part most people never forget. September 2006, a giant hedge fund, a big money firm chasing aggressive returns, is leaning hard on natural gas. For a while, it looks brilliant. Brian Hunter had built a massive position, a trade you currently hold. His idea was simple. Winter gas should stay expensive compared with later months. That was his thesis, your specific reason for taking the trade. When the market moved his way, the fund looked smart. When it flipped, size turned a bad week into a disaster. Here are the facts. Amaranth Advisors lost about $6.6 billion in less than a week. Before the collapse, the firm managed roughly $9.2 billion. After the damage, that was down to around $3.5 billion. The losses were so severe that Amaranth unloaded major pieces of the natural gas book to JP Morgan and Citadel. Now strip away the headlines, bring it down to your level. You spot a trade on your phone during lunch. You're not just asking, am I right? You're also asking, if I need out, who takes the other side? That second question crushed Amaranth. Natural gas is not like leaving a giant S&P 500 fund. Some corners of that market are thinner. Fewer buyers, fewer sellers, less room. Traders call that low market depth, how many buyers and sellers stack at each price. The exit door is narrow even before panic starts. Hunter's problem was not only being wrong, it was being huge. Reports showed Amaranth held extraordinarily large natural gas bets across different delivery months. In plain English, the fund had so much exposure, how much of your account is at risk on a trade, that getting out could push the market against itself. That's the trap beginners miss. A small trade can be wrong and still stay manageable. A giant trade can be right for weeks, then become uncontrollable in hours. Once prices moved against Amaranth, every fix got worse. Hold on, and losses grow. Rush for the exit, and your own selling hammers the price. Reduce a little at a time, and everyone sees the stress. That's what illiquidity feels like in real life. Not a fancy textbook term, a crowded doorway. You reach it, and the doorway shrinks because you showed up. This is why high conviction can be dangerous. Conviction, how strongly you believe your trade reasoning is right, feels powerful going in. It feels intelligent, but conviction does not create buyers for your exit. It does not keep the market calm. It does not guarantee a clean fill when your buy or sell order actually executes. By the end, the position was no longer something Amaranth controlled. The position was controlling Amaranth. That's the lesson hiding inside the $6.6 billion number. The market can forgive a bad idea. It often does not forgive bad size. So if the real danger is being too big to leave, what rule would have kept the exit controllable before the first crack showed up? The pattern is clear. The safest big idea in trading is simple. Your size decides whether your exit is real. You mark a line $2 away. That's where you get out if you're wrong. Your rule says the most you can lose is $100. That means 50 shares, not 500. If the screen looks empty and prices are jumping, maybe that means no trade at all. Call this the position sizing first rule. Quick aside, if this helps, subscribe for 2 a week. 3 checks, every time. First, set your stop loss, a preset price where you automatically get out of a losing trade before you take the trade. Second, do your position sizing from that stop, not from your excitement. Keep the risk small enough that one mistake doesn't wreck your week. Third, ask one ugly question. If price hits that stop fast, can you actually get out close to it? If only a few orders sit there, your fill, when your buy or sell order actually executes, can happen much worse than planned. That's why a giant trade in a thin market is fake control. Getting in is optional. Getting out is the test. Judge every trade by the exit first. Do that, and the next famous blow-up starts looking a lot less mysterious. Before your next trade, ask one ugly question. If 5 people rush for the exit before you, what happens to your price? Can't answer that? Then shrink the trade or skip it. Subscribe if you want more real blow-ups, traders who lost big, broken down this simply. Next time we'll open another case file. Someone was right about the market. It still ended in disaster. Those stories teach the fastest.